Hello, Happy New Year to you, our listeners and market participants, and welcome to KBRA's latest European Credit podcast. I'm Gordon Kerr, Head of European Research at KBRA, and today I'm joined by my colleague, Ken Egan, from our Sovereign Ratings team. Today we will be discussing KBRA's Sovereign Outlook for Europe in 2022 with topics from the recently published Global Sovereign 2022 Outlook, which can be found in full on kbra.com. Welcome, Ken, and thanks for joining me. Just when we thought we were out of the woods and European sovereigns were in for a strong recovery in 2022, Omicron hits us.
Yes, exactly, Gordon. Unfortunately, this latest variant appears to be forcing lockdowns and restrictions once again across Europe, which will obviously weigh on growth and government finances. I guess when booster campaigns catch up, restrictions will ease once more and the recovery we've seen in parts of 2021 can resume. We think the key point from an economic perspective in Europe is that the monetary and fiscal policies in place have worked well. When allowed this year, European economies rebounded strongly, underpinned by pent-up demand and high levels of savings. Consumption drove the recovery. Looking ahead, in conjunction with a favourable rate environment, we have ongoing investment from the EU's Recovery and Resilience Facility, and this is blending on a national level with governmental recovery plans and reforms. As a result, euro area growth forecasts over the medium term are higher than the UK and higher than pre-pandemic levels. The fly in the ointment, aside from COVID-19, appears to be high inflation.
Yes, inflation, the theme of the second half of 2021 and the main focus for 2022. You mentioned the favorable rate environment. There is a risk that it might not stay favorable for long if we have persistent inflation above target.
Yeah, that's the big question, isn't it? We think the low rate environment has been crucial to the recovery in this pandemic. Through the worst of the crisis, sovereign governments have had very low issuance costs and their interest cost is declining and at record lows in some cases, which are credit positive factors. Sovereigns have been able to realign their redemption profile, affording government financing flexibility. And to your point, in general, this does change as interest rates rise to curb undesirable levels of inflation. But we're a long way away in Europe from sovereign borrowing costs becoming a material issue. The deposit facility rate at ECB is steeply negative at minus 50 basis points, and there are plenty of other QE tools that will likely be pulled back ahead of a rate rise. Whether you're on team transitionary or not, with regards to inflation, the five-year inflation swap that the ECB follows closely for medium-term expectations of inflation is currently below target. The recent announcements are positive for euro area sovereigns, with longer reinvestments of the pandemic emergency purchase program and continued public sector purchase program support, albeit at a reduced pace. This will underpin support within the sovereign bond market for the medium term at least. The ECB will likely act slowly and steadily and well communicated. And in this regard, the risks for sovereigns in the bloc seems contained.
Now, Europe is not just the euro area. What about the implications of inflation for rates in economies outside the remit of the ECB?
Yeah, tightening policy in the middle of a pandemic can be tricky and maybe undesirable if growth isn't robust, which leads to an ongoing dilemma for many sovereigns. Ingredients for this cocktail are mildly evident in the UK, where increasing the policy rate to tackle inflation, which appears to be stickier than in the euro area, could curb the growth recovery. Plus, the overall economic outlook isn't as appealing as Europe at the moment. A higher number of redemptions for the UK Treasury are coming up over the short term as rates are increasing. And with less QE buy new issuance as you tighten, this will likely add further headaches for government finances. Taxes are also set to increase over the short-term horizon too. However, let's be realistic and not overemphasize the impact of these factors. The UK remains one of the strongest credits globally, but I guess these are noteworthy points to highlight as policy tightens. Poland, likewise, are looking at this dilemma with the trade-off between hiking rates, which is likely in the new year, versus impeding growth.
Okay, that about covers the big inflationary gorilla. But from a credit perspective, there remains a very large elephant in the room with regards to sovereign debt, and that is the high debt levels. The pandemic has seen governments across Europe increase their levels of borrowing in order to keep their economies from collapsing in the midst of the shutdowns. Are these debt levels not a big concern? Surely governments can't just keep borrowing.
For sure, you're onto something. And this is the main part of our recent Sovereign 2022 Outlook report. What is important to note is the nature of debt is changing. We've had low interest rates for so long that the overall cost of the curve for many euro area sovereigns and the UK is currently very, very low. The Maastricht Treaty debt agreement, for example, was written at a time when the German 10-year rate was 8%, Now it's well below zero at negative 30 basis points. Furthermore, the European Stability Mechanism wrote a paper on this very theme recently and how debt has changed for the medium term. It's probably more realistic to assume the new norm is debt to GDP of 100%. As we pointed out in our report, an enlarged debt load is generally credit negative. Although the sharply falling cost of debt, reliance on fixed rate debt, and in some cases, the lengthening of a maturity structure of the debt softens risks for many sovereigns. Italy is a good example of this in the sense that although government debt is an important credit factor for us, as we get more comfortable with the new debt dynamics, other credit factors are not so overshadowed. The sovereign looks to have a solid growth outlook and at this juncture, underpinned by high investment in the execution of badly needed structural reforms. KBRA has been at the forefront of our review of Italy and has been the first rating agency to recognise the picture for Italy and move the sovereign to a positive outlook earlier this year.
Great. One big theme for 2022 for sovereign debt was the growth in green bond issuance. Do you think this will continue?
Absolutely. Yeah, there appears to be huge demand in Europe. The cost and funding of the transition to a more digital and environmentally sustainable future will continue to be a big theme for sovereigns and one we're monitoring at KBRA. And we might have seen the blueprint for this from Germany earlier in the year. We will see an increasing focus on this both from as sovereigns, as issuers, and politically as countries and the European Commission work to drive financing and investment towards sustainability goals.
That is a good transition to migrate from the economic picture and turn our attention to what is shaping up to be a big year on the political front in Europe.
Yeah, that's right. It will be a big year for European politics in 2022. We have the Portuguese election coming in fast. The French election will be the highlight event of the year. And in Italy, Mario Draghi could very well leave the prime minister post to become the country's next president. Aside from upcoming elections, we have a new German chancellor, a new Bundesbank governor, and a new German finance minister. And it remains to be seen how this will change the current European political dynamics, in particular how comfortable they will be on the financial front with the current accommodative environment, both fiscally and monetarily. Added to that, there appears to be some COVID exhaustion raising its head with protests in various countries. There will definitely be more moving parts to keep an eye on in 2022.
KBRA recently wrote a piece about Euroscepticism receding in Europe. On your point about COVID exhaustion, can populist parties take advantage of the latest anti-lockdown sentiment?
That's a great point, Gordon. I think from an economic perspective, it'll be hard for Eurosceptic parties to make a narrative against the EU and the ECB these days. But certainly with regard to lockdowns and restrictions, we can see some populist parties try to capitalize on that. And it's a theme that we continue to monitor closely.
Thanks, Ken. And one last question. A key focus for some market sectors is the direction of unemployment. It is a concern that we raised in our European Structured Finance 2022 outlook that as the additional pandemic support is withdrawn, we could see a rise in unemployment. How do you see this developing in 2022?
Yeah, in Europe, there is a degree of slack in the labour market, and this will continue, especially with the development around these variants of coronavirus. Until that slack is absorbed and government support measures are fully unwound, we won't see the full economic picture. Similar to the ECB approach, many governments in Europe are taking a slow and steady tapering to those various employment subsidy programs, trying to avoid a cliff edge that the market once feared, although that doesn't look like it's going to materialize. But you are right in that there will be likely some adjustment as these support measures are withdrawn.
Many thanks, Ken. So in summary, we at KBRA expect to see an ongoing low-rate environment to continue in the euro area. However, differentiation will emerge versus peers. Debt levels are increasing, but the risk of this has changed with a changed maturity profile and cost of debt. And politics could throw a spanner in the works yet. And of course, the green revolution continues. Thank you very much for listening. We look forward to bringing you more conversations in European credit. Don't forget to check kbra.com for our latest ratings and research. We wish you all a prosperous 2022. Stay safe, and we will speak to you again soon.